The truth about non directional trading and why most traders still lose. If you don't want to pick a market direction but still want to be profitable, this lesson is for you. Now, you're about to learn how traders make consistent income without needing to guess which way the market is going next. And most traders lose because they believe success depends on prediction. But when you understand how non directional trading works and where your edge actually comes from, everything changes. And if you'd like to see a real working example of this concept, I'm giving away my Safe Wheel trading program completely free for a limited time. It's a hands on system that shows you how to collect premium while safely staying hedged. Just click the link below to get into the course. Now, let's explore exactly how traders profit without predicting direction. Here's what most traders never realize: options are overpriced most of the time, and the market consistently overstates how volatile the future will be. And this means when you sell options correctly, you're collecting more premium than you'll ever pay out, just like an insurance company. In this section, you're learning where your statistical edge truly lives. You're not betting on whether the market goes up or down. You're betting that fear is overpriced and time decay will pay you. But as you'll soon see, the edge can vanish quickly when volatility spikes. Let's talk about where overexposure really comes from and why most traders who follow the old school tasty trade style strategies end up paying the price when volatility spikes. These setups work great when volatility is calm and time decay is steady, but the moment volatility explodes, your so called edge turns into a liability. Let me show you what I mean. So, next, I'm going to get into the traditional option premium selling trade structures again, but how they handle a crash. So, here's the put credit spread 1 week before the crash. This is one in August 2024. So they're trying to make, for example, on this one, make $600, 50% of the credit received, and it's down over $1,500 trying to make $600 after 1 week later. The wheel with the naked put trying to make $1,100, down $3,000 trying to make $1,100 1 week later when there's a crash. The iron condor, this one's not so bad, trying to make $500, down $289. The butterfly, 1 week before the crash, trying to make $500, down $400. The 112. So you're trying to make $500 with this 112, 50% of the credit received. There's a crash, you're down $5,400. That's shocking. That's not good. The crash really is not good for the 112 trade. The poor man's covered call, 1 week before the crash, you're hanging out here trying to make $400. Week later, you're down $1,400. So basically, the downsides are those black swan events. These events can be challenging to predict, and they lead to significant losses for option sellers who are not prepared. You can get margin calls. So at the worst possible moment, you've got to get out of your positions when the spreads are really wide because you got to take losses so you don't take more losses. So you have these stop losses, and you got to get out with the wide spreads, and you just go to cash at the worst possible moment. And one bad trade. High win rates can be a vanity metric, and one bad trade can wipe out years, months, or years of profits. And I call this the 95% trap. So high win rates mean nothing if you're living with constant anxiety and sleepless nights. Why build a 40% return strategy if a crash wipes it out in one day? So just to recap, market crashes can cause 40 to 60% drawdowns in a portfolio that applies inefficient options trade structures. And the only asset that increases in a crash, that we know increases in a crash, is volatility. So the goal here is to be long volatility. Now, being long volatility, that's nothing new. But the problem with being long volatility is the cost. Every long volatility hedge has a cost to maintain it. In other words, the long volatility that will save your account when the crash comes has a cost to overcome during those non-crash periods. It's a tough balance to maintain, and most cannot do it. The options trade structure needs to be very specific, and the trade plan needs to be very specific. Now, this is the PL5 2 weeks before the crash. And the reason why it's not 1 week is because this is an actual real trade. So I wanted to use a real trade. I could have done it 1 week, it would have been the same result. So the trade here had a small window to capitalize on the crash. And you can see here on August 5th, 2024, my real trade that I got out. And I had a $3,000 profit target on this trade, and I made $25,000. So I made 8 times the normal profit target because of the crash. And that's a real trade. That's my real account. And here's my equity curve again to show you what happened with my portfolio on that day and a few days later. So we know, and there's not an edge with level 4 trading using inefficient trade structures. Selling option premium without a hedge leaves a portfolio vulnerable to extreme market moves and crashes. Now, all of these setups belong in the traditional old school hasty trade playbook, and they work beautifully until volatility spikes. And that's exactly when most traders blow up. And these strategies are mathematically short volatility, meaning your P&L drops when the volatility or the VIX rises. And they're called non-directional, but they are not hedged. And that's the difference between having an edge and being exposed. So instead of abandoning premium selling altogether, the answer is to evolve with it. Hedge before the spike, structure your trades for survivability, and turn short volatility into a managed, sustainable edge. So, how do you fix it? You hedge before it happens. You see how professionals build stability by pairing every short position with protection, long puts, long volatility, and other structured hedges. That's the foundation behind every one of my systems, the PL5, the earnings edge, and the safe wheel. By adding a built-in hedge before selling premium, you don't just make money, you protect your ability to keep making money. You're not just limiting your upside, you're preserving your long-term survival. And that's how real consistency is built. Once you trade this way, something changes. The anxiety of market crashes disappears. You stop reacting to fear and start operating from a plan. You'll notice your equity curve looks smoother, your decisions get clearer, and you finally understand what it means to trade with control instead of hope. If you want to apply what you just learned today, I've made it easy. The Safe Wheel Trading Program will show you step by step how to structure a hedged premium selling system. You'll get my flow chart, the checklist, and the live trade walkthroughs completely free for a limited time. Fast track your success with the Safe Wheel program. Just click the link below to get in. Keep learning, stay hedged, and I'll see you in the next lesson.